very happy to welcome people to this panel discussion. I look forward to hearing the insights. We've chosen 3 people for this panel because of their following combination. One is they've done distinguished and very important academic research, but they're also been recently involved in explicit policy making and policy advisory positions. And so that gives us, that gives them a very interesting and important perspective on research and kind of what type of research that is becomes directly useful for policymaking, and but both short-term and long-term. So we want to explore those type of questions, and more generally what they see as some of the challenges going forward in terms of some of the macro finance issues facing the world. Now, we're gonna start off with me asking some questions, and then we've got a long list of questions that have been submitted, which we won't be able to go through all of them. So I apologize in advance that we may not get through all the individual questions. I will do some selections as we go in order to kind of fill in holes as I see that would be most fitting. There might be a little bit of time left over for some additional questions. We will kind of play that by ear. But anyway, so I'd like to welcome our 3 panelists. Anil Kashyap, who's now my distinguished colleague at the University of Chicago, as he indicated in his own talk, is on the Financial Policy Committee of the Bank of England. Laeven is the Director General of the Research Department at the European Central Bank. And finally, Shin is the Economic Advisor and Head of Research at the Bank of International Settlements. So I'm going to start off with a question that's kind of more of a look-back question. So as you think now about the financial crisis, 2007, 2008 financial crisis, what type of research do you find to be of particular value? And what type of research then will help you think about guarding against future crises? Now I'm going to go in reverse alphabetical order, since people too often go for alphabetical order. So I'm going to start with Hyun Shin and let him go first in this.
Okay, thanks, Lars. Thanks for this invitation. It's great to join you here with everyone, both on the panel and in this virtual audience. I guess. If we look back to the previous crisis, a couple of features really stand out. The first one is who the main players were. It was very much a bank-centric crisis, in that it was the financial intermediaries who were at the epicenter. I think we have now, with the benefit of time, we have now sifted through the data. I think there's been a great deal of progress in banking research, both theoretical, but especially empirical, using microdata. So I think that's something that really has shed a lot of light on one very important feature of the previous crisis. The other feature, which also is very striking, is how international it was, and not simply that the financial stress was pretty widespread, but also that to understand what was going on, you need to really piece together some of the connections happening in cross-border. So one stylized fact, which I think is pretty interesting, is that if you look at the funding source for banks in the lead up to the crisis, so up to 2008, kind of stylized fact is that around 80% of the assets of prime money market funds in the US were the liabilities of banks. So money market funds, at least the prime money market funds, were mainly financing the banking sector. So 80% is financing banks, but 50% was actually financing European banks. So they were actually the liabilities of banks that were headquartered in Europe. And we know that on the asset side, there was a lot of lending being done by banks headquartered in Europe. And so to understand what was going on in the lead up, it's very important to piece together that sort of link. So why was it that we had European headquartered banks being such an important player, and why was it that they were involved on the lending side as well? When we fast forward to what's happening right now and what happened in March of this year, it was this time around the banks were not at the epicenter of the of the stress, in the sense that they weren't the they were not at the they were not if you like the amplifiers of the stress this time round. And instead, it was very much the market-based intermediation system this time around, which I think was, very much at the epicenter. So I think if we then were to do a retrospective of what happened in March, I think the kind of techniques that we'll use, the kind of data and kind of insights that we'll gain will also be different. So let me just stop there and pass on, so that maybe we can come back to this later, Lars.
Okay, great. Luke?
Yeah, thanks, Lars. Also from my side, great to be part of this. Looking forward to the questions from all the students. It's a tough question for me because I'm very much into the current crisis, so it's sort of a bit of a memory test for me to go back 10 years or more. But I would actually start by maybe slight different angle than what Hyun took, which I guess is good, which is, in my view, banks were not really at the center of the previous crisis. We learned a lot about non-banks, about repo markets. A lot of research went into that as well. And of course, in the US, the housing market was at the epicenter of this, of that crisis. And I think what came out of that was a call in general for financial institutions to have less leverage, and for a prudential regulatory approach that looked more at the financial system as a whole, which we dubbed Microprudential Regulation. And I think for the financial economists, what this meant was paying much more attention than maybe we had done in the past to market failures. They do exist. So a lot of research on fire sales, because they were at the center of that crisis. And for macroeconomists, I think there was a big call to seriously look at financial frictions and embed those in the models. And this is also what we at central banks focused on most. All the models that were at the basically are that underpin policy making in central banks. So they are the start of the whole forecast process, where we forecast inflation and output and other macroeconomic variables to decide on monetary policy stance. All these macro models, whether it was at the Federal Reserve, the Bank of England, the ECB, or other major central banks, did not really have any serious financial factors in them, and for sure not financial regulation. So a lot of effort went into actually having some type of banks in those models, capital regulation, liquidity regulation, and how that then interacts with the economy at large, how shocks, whether monetary, fiscal, get propagated through the banking system and the financial system at large onto the real economy. Indeed, if we then get to the current crisis, then I'm totally in agreement with Hyun. This time, the bankers were not really the culprits. This was a truly external crisis, and that's what made it so different. This time around, it was not a financial crisis. It's a health crisis that humans decide to turn into an economic crisis, because the only way to deal with this health crisis is to go on lockdown. Yeah, we can talk about that maybe later on, what type of questions that brings. But for me, as I said, to recap, the main novelty of the previous crisis was that non-banks were a very big part of it, and the housing market was a very big part of it. There was a big call for macroprudential regulation, which unfortunately to this day, very few countries have taken to heart. If you look at the US, there isn't much of a macroprudential framework in place, but that was the main lesson also from academics coming out of that crisis.
Neil?
Okay, thanks. And it's great to be with Luke and Hyun, two longtime good friends, and with Lars. I guess I'm a little closer to what Luke was saying, that the non-banks were the things that we didn't understand. I mean, I accept that there was a credit crunch and a fire sale, but I think it had elements coming from both the banking and non-banking system. One thing that's interesting is I still am not sure that there's much consensus of how to get beyond the single interest rate model of macroeconomics that was present in 2007, where you take a single interest rate and the expectations hypothesis, and that's viewed as good enough. So I think that if you ask people what's the second or third set of interest rates that you should put into a macro model, there's still not a great deal of consensus on how to bring a financial system in. I think adding some non-banks is very important. Big dispute as to whether or not you need to know anything about the plumbing of the financial system and whether that was a one-time problem in the 2008-9 crisis or whether it's been important. I would argue that it was important again in the COVID crisis, even though the COVID crisis was not fundamentally about the financial system causing problems. It was just the recipient of problems that may or may not end up being amplified. So I think that's still a live area to go as to how to bring in a financial system in a parsimonious way so that it can potentially amplify shocks or not, and to think about where you need to monitor and watch for trouble. So let me stop with that.
Okay, thank you. So let me follow up with the following. So Luke mentioned the idea of models and the fact that after the 2007 financial crisis, we had to do a bunch of repair in the macro models. I'm wondering kind of more generally, kind of as we look forward, first of all, have you really repaired those models in ways that we have confidence in? I understand that if a crisis exposed the gaps in them. I wonder how valuable quantitative modeling actually is in terms of your day-to-day policy thinking. Are we confident that we've done the repairs? Or more, and let me turn this into a little bit more of a positive question about what type of research would help you in terms of gaining even more confidence in using these models that people are building as tools for policymaking. Going forward, where do you see as the kind of really important challenges in terms of the modeling aspects of things? And at the same time, I guess I would like to have both Hyun and Luke tell the students or the young scholars a little bit about what they actually do in their jobs. Neil's already had that opportunity this morning, but it would be nice if we could have them chime in on that as well. So this time, why don't I have Luke lead things off?
So quantitative models are the way to go, and they are more complex, but the reality of central banks and most policymaking institutions is that we need to have a number. We need to decide how much to pull that lever. And so what this means is we cannot, first of all, we cannot stop with just some positive analysis. So there's a lot of empirical analysis that's very useful, especially if it's well identified, but it's really insufficient for decision making. I mean, we have to take the right decisions, and so we need to take care that we have considered all the various trade-offs. Of course, it will always be incomplete, but we need to do the best we can with the tools we have. So we really want to put a lot of emphasis on considering general equilibrium effects, whether these are, let's say, substitution effects or some indirect effects, and not be satisfied with only partial effects. And also our research, we're very big on making sure that we approach questions from different angles so that we consider multiple channels. I know that academic journals typically want focus. So you focus on one particular channel and you really convince the reader that that particular channel also exists. So for instance, if you think of what's the effect of negative interest rates? Well, you have the standard interest rate channel. There's interesting recent academic work that there may be a point where you get a reversal rate where rates are so negative that they may actually hurt demand. There are also valuation effects. They boost asset values. You have to take into account all of these effects. But I think the real difference with academic research is that all of this optimization in policymaking circles is constraint optimization. There are a lot of constraints in place in reality that we typically abstract from in macroeconomic models because things get quickly very complicated. These constraints vary not just from financial and economic constraints, political constraints are often the most important ones, the dominant ones. So you really need to think in sort of constraint optimization terms or second, third best type of worlds. That makes it complicated. Now, I do think as economists, we have all the tools in place to handle these questions. It's just that the system that we try to solve quickly becomes very complex. So if you ask us, where do we need to do more research on? I think it's on, in terms of the tools, how to manage increasingly large data sets with larger systems to still get ideally closed form solutions is one. A very specific question is that also coming from the previous crisis we still haven't dealt with is that often we assume linearity in our models, but most of the time in reality, there are reasons to believe that effects are actually non-linear, especially financial shocks. When leverage becomes binding, it's very natural to think of that as being something non-linear. But we still need to develop methods to solve those non-linear models. And the most fundamental question I still have from the previous crisis and from any crisis is what is really the trigger of the crisis? If you make this endogenous, this is not just some sort of shock coming from wherever, it's some coming from within the system. And we still don't have good models that deal with that. So what do I do on a day-to-day basis? So I run a research department in a central bank. So we are like almost 100 people. 65 of those are PhD economists. Half of those are trained in the US and half of those at the better schools in Europe. All of them are Europeans, so in that sense there is not that much diversity. Neither gender nor in terms of nationalities, they're all Europeans, but there are many countries, little countries in Europe, so I guess there are a lot of languages at least. The mandate that we have is we are really the bridge between academia and the policymakers. The policymakers in our case are the 6 board members of the ECB that together with the heads of the central banks of other European countries decide on interest rate and other monetary policy instruments. And we have to give them the best research-based advice to inform and guide their policy, whether this is on the forecast or on the actual policy decision. And as I said, we are a bridge both to make sure that they are aware of the best and the latest research out there to the extent it's relevant. And very often the research moves rather slowly, or research focuses on, let's say, US evidence alone. We then translate this research or build on existing research to make it more applicable for Europe or for the central bank community specifically. So we do a lot of our own research, and then we have the same standards as in academia. So our economists are also supposed to publish in top journals. And that's really to make sure that this is an external validity in terms of the quality of the research, but it's most importantly a way for us to make sure that we have a foot in the door in the academic network, because it's very important in academia that you know each other, that there's credibility, and the only way to show that is by consistently publishing in the best journals. And we meet on a weekly basis with our policymakers, and they take decisions once a month normally when it concerns interest rate policy. But if there's a crisis like that's been ongoing earlier this year, since then we have been meeting almost on a daily basis with them.
Good, thank you. Anil, would you like to go next? Kind of looking forward, if we think about how useful are the existing quantitative models that we have for policymaking, and what do you see as like the ways to repair them? And are the models that are most useful ones that are explicitly quantitative, or are the more qualitative ones the ones which you really trust at this juncture?
Well, it depends. I mean, I think the biggest hole actually in what we've got right now is measurement problems to do with the non-bank financial system. So a lot of the questions, like right before we came on, Hyun and I were chatting about some of the stuff that happened in the beginning of this COVID crisis. And it's just remarkable how little we measure. And so it's very hard to do quantitative stuff if you can't calibrate to get magnitude, just basic things. So an example would be, why was the amount of QE that was needed across the globe so big? Why did it take so much to stabilize things? Was the shock from COVID really that big, or was there embedded leverage somewhere, or some sort of just insolvency, or whatever you want to call it? The policy response that we've just lived through was very, very large. And yet when you try to look for the shocks, they don't seem that large. There was a lot of fiscal support as well. So I'm most interested in seeing more work done on measurement, because I think once we have that, we can go to the quantitative stuff. But I don't think that there's a workhorse quantitative model that can really help us with many of the main questions.
Thank you. Hyun?
Lars, on your question about what kinds of models would be most useful right now, I think one approach would be to let me just take a step back. I think we have now a very good set of models which build on the frictionless macro models, and then build in various frictions into that, so that we have the shock and propagation mechanism. So once you have a shock, you can then model the propagation of that shock. There'll be balance sheet constraints. You can see how the initial shock is going to be amplified down the road. I think what we do less well are theoretical approaches that tell us something about the run-up to the crisis. The build-up of the vulnerabilities. So if you think about financial crises and the period leading up to crises as periods where there is a lot more risk-taking, there is a great deal of the build-up of leverage, among other things, which are then going to be exposed once the shock arrives. I think that's a slightly different approach, and I think we have fewer models that actually speak to that. So do we have some good models that actually tell us something about the build-up to the crisis? Why do we see an increase in leverage, which are then exposed? And I think one way of approaching that would be to ask, what are some of the determinants of risk-taking, and how do they vary with some of the underlying fundamentals, or indeed other market variables, so that we can see these vulnerabilities building up. I don't know whether, let me just show you a couple of charts just to make it a little bit more interesting.
Yes.
So this is just adding up the total assets and the equity of 17 large US banks, and we're going back to the early 90s, and it doesn't show up as well on the usual scale. But if we look at the log scale, what you do see is that there is a bit of a kink just at the crisis. That before the crisis we had this very rapid increase in both assets and equity, and then we've seen the slowdown. I think after the crisis, as Luke mentioned, leverage has come down. So assets have increased around 2% a year, as opposed to equity, which is around 4%. What's really interesting is the euro area banks. If we have the same exercise for 26 euro area banks, it looks like this. It's not as informative as the log chart, where you do see this again. Very interesting phases where in the run-up to the crisis, you had this very sharp increase in assets, whereas now we have something more like a sort of retrenchment. And I think we have good models for giving us insights into how will the shock propagate once the shock arrives. I think we have less good models in telling us, well, when would you see this phase shift where you go from something which looks pretty subdued into a period when there's, on the surface at least, a great deal more risk taking. So I think that is one, I think, theoretical task that's still ahead of us. Although I think there has been some progress, but it's probably less. There's probably less progress on that than the models that actually look at the shock in propagation. How would we get at this? I think in terms of the data, I fully agree with Anil. I think measurement is really important, and getting very detailed micro data is clearly going to be very important. What I would say, though, is sometimes it's quite insightful if you also drill up to the aggregate as drilling down to the micro data. And what I mean by that is, if you look at the global picture and see how the pieces fit together, you can actually come up with stories or narratives or insights that you would actually miss if you were just looking at the details. And I think that's especially true for the banking sector because of its global nature. And I think some of the best insights are actually obtained if you look at the aggregate data. So it's not going to be very helpful for you to get papers into the top journals, but from a policy perspective, being able to gain an insight into what just happened, and what was it about the last few years that they gave rise to whatever that you saw. That's actually quite helpful, and I think the dollar intermediation that when Shin talked about yesterday, I think is also a very good example of this. In terms of what we do at the BIS, a lot of it is similar to what Luke just outlined. There are research economists. On top of that, the BIS is also the institution that hosts the various supervisory committees. I'm sure everyone's heard of the Basel Committee on Banking Supervision, which is a kind of which is the standard setter for international banking supervision, and where the regulators come and discuss the regulatory standards. On top of that, there are the various committees that bring together policymakers in the payment system. For example, the Committee on Payments and Market Infrastructures. This is where the payment standards are discussed. So as well as all these committees, we have also the statistical function. So we actually draw on the inputs from the central banks, and it is at the BIS that we put the pieces together and then publish the aggregate numbers. So it's at our stage that we can see some of the aggregate numbers that are around. But broadly speaking, it's we are a grouping of central banks. So our constituency are the central banks, and as well as providing the intellectual support, the research. There's also a lot of practical policy coordination going on as well.
Thank you. So now let me turn to the current pandemic. We've certainly seen countries necessarily accumulate substantial amount of debt as the governments have been compelled to respond quickly to the potentially dire situations. Further challenges to the government balance seem likely in the near future. We're not about to escape this problem immediately. Up until now, we've become accustomed to this kind of low inflation, low interest rate environments that seemingly make debt accumulation not so much of a concern. How about going forward? How much of a long-term problem do you think is being created? And are you concerned about a potential inflation increases or increases the cost of servicing debt? So let me this time start with Anil.
Okay, well, as Hyun was just saying, you know, our ability to detect these things ex ante is very low and hard. So right now it's not a problem, and then someday it will be a problem. I don't think with impunity most of these countries can get away with issuing so much debt. Of course, if you've been betting on that when Japan crossed 150 and 250, you know, they have names for people that have tried to short countries that look like they have unsustainable amounts of debt. So it's hard to know, but I think, you know, over the next 20 years, will some advanced economy have to restructure its debt? I'd probably say yes. I don't know which one. I don't think it'll be the U.S. The dollar, for all the reasons that Hyun and Wenjin have talked about, seems like it's still pretty strong. But I do worry about the debt buildup, and I think it's more likely to go away via inflation than financial repression. Those are the two historical ways that you get, as opposed to just outright default. So yeah, I think some of these countries have done it, and I think this will become a problem even in the corporate sector in, you know, next winter, if we get a resurgence of the virus, and then you're trying to ask companies to continue to bridge. Will you keep layering more debt on? And will people just conclude that it's not worth it? I think that's a very live question. And it's something where I think people's thinking has changed from 3-4 months ago, where they thought maybe just big, massive support was the right way to go. And now liquidity doesn't look like the problem. Solvency looks like the problem. And for that, layering debt is not great. Let me stop there.
Hyun, would you like to go next on this one?
So, Lars, I think we should distinguish between the public debt, corporate debt, and consumer debt on the household side. I think what the shock has really shown is, and the fiscal response has been really massive this time around. I think the fiscal response has been much larger than what we would have thought was going to be feasible. I mean, let me just see whether I can just share one slide on this, on the fiscal response. Let's see. So this is a chart that we had in our annual economic report. It's as of the end of May. It's the size of the pledged fiscal packages this year, and we've and here it just divides them into advanced economies and emerging market economies. So in aggregate, it's around 10% of GDP in terms of budgetary measures, and around another 12% in terms of guarantees and funding schemes. This was all conditional. So I think this would have been a very big fiscal injection in any case. If the virus lingers, if we find that the pandemic is going to be protracted, I think we will need more. You see that for emerging markets, the size tends to be a bit smaller, much smaller in fact. And it's also worth asking why we have this difference between advanced and emerging economies. I think one issue that really comes to mind is what we call fiscal space. How much do countries have in terms of fiscal space? So when we talk about that, there must be some kind of implicit theoretical framework that gives meaning to what that space is. I think our understanding of fiscal space is, has been wanting. I think in the sense that some countries have, gone beyond previous, rules of thumb in terms of what would be sustainable. Other countries, in emerging markets, tend to find that even sort of fairly moderate numbers tend to cause problems. And I think, one set of issues have to do with how do we define fiscal space, how, what determines fiscal space. And I think that's going to be a very important issue going forward. On the household sector and the corporate sector, probably, there it's going to be a matter of, what is the impact of the pandemic on household finances or corporate finance, and thereby the knock-on effects to bank solvency, rather than the issue that we had before the previous crisis, which was about the debt buildup being, if you like, the creating the underlying vulnerabilities to the unwinding of that increase in leverage. I think it's a different set of issues. I think it's very important that we distinguish the debt issued by the government and by corporates and households. So let me just stop there.
Okay, Luke?
Yeah, Lars, I think that's probably the most important question that you could have asked us. I think that there is a major issue going forward, but let me also say up front that this has been the right course of action by these governments to have a major fiscal stimulus and not let the economy disappear. So what will happen going forward? I think it's a particularly dangerous combination where we see both public and private sector debt increase in most of the advanced world. It's interesting that from Hyun's chart, you see that Germany is the one first and foremost, that traditionally fiscally prudent countries, the one that now is using those reserves to stimulate the economy, and not only for the benefit of Germany, but for the benefit of, I would say, Europe and the rest of the world. They are a very big trading partner for many countries, as you know. So because public and private debt are both on the rise, we can also not just reallocate resources so easily as we otherwise would have been able to do. And so I do expect a major wealth redistribution, and I do believe in very high levels of debt hampering growth going forward. So growing out of this crisis with a high growth rate is unlikely to be what we're going to see. There are other options. It doesn't have to be inflation. Actually, debt restructuring is one. Some form of financial repression, of course, is unthinkable in a world where we allow capital flows to move freely. But I think the immediate aftermath of this is almost the opposite. I think for the foreseeable future, as this pandemic continues to spread, it will depress inflation. And interest rates have been on decline for many years, and I don't see any reason for this to change dramatically very soon. So the question is really the one you were asking, is sort of what happens probably a few years out from now. And I think with growth being low, the real question on debt sustainability will depend then on interest rates. So as long as interest rates and inflation remain low, debt in most advanced economies are likely to be sustainable. The natural rate of interest was already low before the crisis. It's likely going to be even lower now with precautionary saving, uncertainty, low investment, and all that. But at some point, this is likely to reverse. And I think the market will test indeed some of these countries. Now, if I look at countries where that is very high, one is of course Italy, but the recent decision by the Europeans to actually give very substantial grants to that country to actually pay off some of the debt that was brought about by this corona crisis, that's a very strong signal that there's a lot of solidarity there in terms of burden sharing. So I'm much less concerned today than I was some weeks ago about that part of the world. And of course, for me, the two major implications will be the role of central banks is likely going to change, because with such large debt burdens in all advanced economies, there's enormous pressures on central banks to keep interest rates low, even if inflation would demand different interest rate paths. And so the independence of central bank will come really under pressure going forward. That is one very negative development I see. Now, the other is that if central banks do come to the rescue, of course, it's relatively easy to make the debt sustainable, and especially in countries where a lot of the contingent liabilities that governments have could actually be done away with. Think about the social security and other benefits that citizens have been promised. I can think of some of those countries on Shin, where it's relatively easy to reduce those. So if you put together the ability to do away with some of these liabilities and basically default on them, plus the seigniorage that you can take from central banks, I think at least for major reserve currencies like the dollar, the euro at the moment, I think that can be made sustainable. And indeed, I'm more worried about these emerging markets that already now cannot stimulate their economies. I mean, emerging markets, when confronted with this type of crisis, the first thing they have to do is to raise interest rates rather than lower them, because they have to fight capital outflows. They don't have any fiscal space. They have very much less credibility in terms of honoring their obligations, so they cannot carry such large debt burdens. So for them, the situation is much more dire. But if we limit the question, Lars, to advanced economies, I am worried, but I'm less worried about the debt not being sustainable. I'm worried about the way it's going to be made sustainable. I think it will hamper growth for the foreseeable future. And that will probably lead to some massive reallocation of resources in the economy that could increase wealth inequality. And so I think for me, the biggest risk of all this is some sort of political crisis. Are we able to, the way that debt will be made sustainable, is that going to be acceptable to the biggest part of the population or not? And so there are a lot of aspects about this crisis that economists cannot agree with epidemiologists. They don't like their stories. Is this a supply shock, aggregate demand? But one thing we can all agree on, that there will definitely be an increase in public debt, and it's going to be a complex issue to get out of it.
Okay, thank you. At this juncture, I'm going to turn to some of the submitted questions by the students. The first one, do you think that central bank interventions, both since the financial crisis and the pandemic, will create more moral hazard problems going forward. So maybe start with Hyun this time.
I think the if we look at the events of March, I think it was a very sharp crisis, but it was pretty short-lived. I think the issue of moral hazard, I think, is always hanging over us. But I think we can also overplay it in the sense that if the alternative is not to intervene and let the crisis play out, I think the collateral damage would be that much larger. I think there is an issue of the time horizon in that when a financial institution goes into engages in takes on a risky asset position, I don't think it's with the expectation that you would actually be bailed out, that you would actually increase leverage. I think it's more to do with whatever your internal risk models or whatever your assessment of conditions going forward would actually allow you to take. So I think that aspect, I think, is probably more important than the expectation that somehow you will be bailed out. The horizons tend to be much shorter, it seems, in these kind of acute financial crises. So it's related to what I mentioned earlier, which is if we could have a theoretical framework that gives us a better handle on risk capacity. So what is it that determines the degree of risk that you take on? I think we can write down models where moral hazard plays a very important role, but probably there are other elements which are more important. Yeah. So let me just stop there.
Luke, would that go second?
Yeah, this question comes up in every crisis, and I think Hyun's boss at the moment at the BAS, Augustine Karstens, once told me a nice story at the memorial service of Mike Musa, was a former chief economist of the IMF. So these are, broadly speaking, let's say Chicago school trained economists. They know inside out what moral hazard means. And when he became the Minister of Finance in Mexico, when he was in a very important position and there was a major financial crisis in the country, he said the first thing he threw overboard was moral hazard. I mean, in the midst of a crisis like what we have seen again this year, I'm totally with Hyun, but I would put it even stronger. I mean, you have to go in full force, put out these fires, and you have to just run over everyone in your way that is using the words moral hazard as an excuse. I mean, that's something you worry about later. The alternative is just a devastated economy, and it's very easy to make up the balance of what's the right course of action. And then in terms of moral hazard, indeed, that is then you have a time dimension, as Hyun said, but you have a lot of time then to do something about that, going out of the crisis. And so this can be regulated with the right interventions. If you understand, like Hyun also was saying, whether investors return then and or take advantage or put in liquidity, is it because they expect bailouts, like Jean Tirole, that's a nice model. At the moment, our reading typically is that because of low interest rates, if they have a lot of liquidity, they're just looking for yield. There's a search for yield. It doesn't have to be moral hazard, but you have to, of course, watch out for it. And I think it's the lesser evil, and it's actually every time we intervene, there is one governor that mentions this, and honestly, I'm getting a bit sick of it.
Anil?
Well, I want to try and share my screen to show something here. I was talking to a very senior person from the Federal Reserve, and I asked this, I'll say it was a him, it doesn't give much away. I asked him, what do you think about moral hazard? And he said, I thought it was like Dunkirk. We just had to get in and go. And there wasn't time to be worried about that. But what was happening was very strange. So I've graphed here the 10-year rate in the VIX. And if you look over time, these two are very negatively correlated. When the VIX rises, the 10-year rate falls because there's a flight to safety. And you could see, I've highlighted in the green part, classic example of that, where the VIX is starting to take off and the 10-year rate's rising, falling. And then you see in here something that's very strange. The VIX keeps going and the 10-year rate keeps rising. And that's the period in March when markets were cracking. And the Fed intervention and the Bank of England, the ECB, everybody intervened massively to turn this around. I guess the thing that makes me wonder about all this is how can stock prices in the middle of a pandemic, when the news is so bad, show almost no losses to equity? I mean, we're certainly in the middle of a world where lots of investors think risk on is the right way to be trading, and that's because the central banks have your back. And I think it is a consideration as to whether or not the next time when something goes wrong, whether the central banks are going to have to just do the same thing, or whether they're going to be called on. In this case, I agree. I would have done it. I would have gone as quickly as we could have. But I do wonder how they're going to back down and say, we will let volatility reappear, we will let some losses be had, and so on. I agree it's a problem for another day, but I think it's a real problem. And there's certainly many people in the market that think that, you know, we've got QE infinity, and QE in every possible asset class will be deployed. And that's probably not a healthy thing for preventing imbalances from building. But I don't see a great way out. I mean, one way you could try to exit is to say, we will stabilize the treasury market and the sovereign market, but we're not going to necessarily backstop the rest of the financial system. And I think that may be a debate that we wander into, which would be interesting.
Okay, thank you. Let me turn to another question that was submitted. Do you think in the post-financial crisis, macroprudential regulation has contributed to slower growth rates? So let me start with Luke in this case.
Well, actually, I was kind of wondering when you asked the question, what country does the person who asked the question have in mind? Because if I think about the US, there is hardly any macroprudential regulation in place, so I don't think it had much of a bearing on growth. But that aside, most other countries are not all that different. They have put frameworks in place, and probably what Anil is working on a day-to-day basis in the UK, that's probably the poster child. But even there, I mean, it's relatively limited in terms of, you know, when we thought of all this, how much could be done and how much has been accomplished. It was probably a little bit too little and too late. And then the crisis came, and at least what has been built up in terms of macroprudential buffers, I mean, there we've followed the standard recipe that theory would guide us on, which is we have released most of these buffers now. And beyond, we have really relaxed a lot of regulations to buffer the financial system. So I would say, because it was so slow and little and late, I don't think it had a major impact on growth prior to this crisis or post the previous crisis. And at the moment, if anything, it has a beneficial effect on growth. The fact that we are releasing whatever little buffers have been built up.
Anil?
I was going to start by the same point as Luke. I mean, show me where the macroprudential stuff was very heavily deployed outside of the UK. I mean, certainly in the US there's none. So I don't think it's been there. I mean, the microprudential measures, I mean, we've kind of more than doubled capital ratios at banks, but I think the verdict on that has to be a good thing, that the banks are actually still solvent right now and operating. So I don't see that as really a serious consideration at this point. I'll stop there.
Hyun?
Yeah, I think Anil's pointed, I think, is a very good one. I think we have to also think about the horizon over which we measure the growth as well. I mean, you could argue that there is an intertemporal trade-off here, where if you can slow down or mitigate the boom that could lead to vulnerabilities, you will actually have a longer period and high growth over a longer horizon. Yeah, but I agree that contrary to a lot of the talk, the actual implementation of macroprudential measures, regulation, I think is less than we may think.
Okay. So let me turn to another question. So this is a little bit, but I'm going to switch gears here temporarily. And this goes back to earlier discussions by both Luke and Hyun. The specific question is, what are the actual advantages of conducting research at regulatory institutions? And what can you learn in addition from working on policy issues? So why should these positions be attractive to some of the young scholars attending these workshops? So I don't know, Hyun, do you want to say a little bit about that, and Luke?
Yeah, sure. I think the orientation is different in the sense that research in a policy institution it is guided by the policy questions, and so it's I think a great place if you have insights that will shed light on the big policy questions of the day. You also would have access to data and other institutional knowledge from the whole array of colleagues that you have that you wouldn't have necessarily in academia. So I think those are the advantages. I think the gratification, if you like, the rewards are perhaps a little bit shorter term, in that the projects tend to be on a shorter fuse. The answers will need to be, ideally you should come up with the answers that are virtually right, rather than wait until you have the full definitive answer after a much longer period. So I think the horizon is shorter. On the other hand, if your interest is in fundamental research, very foundational research, which will feed into the agenda in other areas, then clearly this is something that's better done in academia. Let me turn to Luke. Luke, I'm sure, has many insights into this as well.
Thanks, Hyun. Well, a lot of similarities with what you have to say, naturally. I think, one advantage that you often hear, and it's just true and increasingly so, is that you have access to rich data. And so there's such a premium now on identification and having micro data sets. A good example, the ECB, is we have now credit register data for all the European countries. So you can really isolate demand and supply effects in credit markets by matching banks to their borrowers, be it firms or households, in ways that are unthinkable in the US, where the Fed doesn't have such data. And then you have multiple countries, and there may be some regulatory action in one that may spill over to another. So there are lots of things you can do with that. you also hear firsthand of all sorts of regulatory interventions, and so it gives you lots of ideas and food for thought in terms of more kind of applied research questions, if that's what you're interested in. I think the main attraction is that you're ultimately close to the action at the central bank. I mean, there's a pretty big lever that is being used or not every month. And if you can influence the person that holds that lever, you have a very big influence in ways that in academia it takes you a long way to reach the top to a level where, like Lars, you can have that type of influence directly, but most academics are a bit in the shadow. But you should like that. You should really want to have that influence, because within a central bank, unless you're the policymaker, you also operate in the shadow. So you should really care about this public good aspect, where you have the same training, but you want to use it not to build your own CV, but for this particular important public institutions to make the right decisions in ways that maybe not always so visible, but that impact the well-being of citizens in your country. I think one added benefit is that as you do this, researchers are typically a minority in these institutions. There are a lot of what we call plumbers, but these are people that really are in touch with the markets. Nowadays, central banks are actually the biggest player in the markets. They really know how these markets work. And increasingly, as academics also get interested in these aspects, you have experts around the corner on the same floor that you can turn to, that in academia may be difficult to find. You should also like working in a team, because it's not your individual glory. It's sort of as I said, the glory of the institution as a whole. This is not for everybody. But at least in sort of our neck of the woods, like where Hyun is and where I am within these institutions, within research areas, the difference is not that big. And I would really welcome academics and researchers to also try it. And this is not a one-way street. A lot of our researchers go back to academia as professors. We have also professors come to us in more senior positions. There's quite a bit of a two-way street. We have a lot of academic consultants that spend any time that interests them, from a month to up to 4 years, regular visits, working with researchers on the relevant questions. So it's not kind of a black and white and very separate world at all. And I think this is a win-win for both sides.
Was that to put on your Bank of England?
Can I
comment on this?
Yeah, just two things. I mean, it's not just mundane questions you get handed. I worked at the Fed for 5 years before coming to Chicago, first as a research assistant, and then as a staff economist. I got several I got 4 or 5 top 5 journal articles written during that time, motivated in no small part by questions that were being handed to us. The paper I gave in my session with Guido was all sparked by thinking about stuff at the Bank of England. So you get good questions. More importantly, if you're going on the job market next year, they are actually hiring. You know, it's great to want to be an academic, but you got to find a university that's going to be hiring. Central banks don't go broke. So the resources there aren't to be laughed at. I mean, they have very good research assistants. They have all this data. They have fantastic seminar series where everybody in the world comes through the top central banks. It's a good place to go. I think most people overrate being at a lower tier academic place compared to a very good policy institution. You have people like Luke and Hyun to talk to, and you don't need 20 colleagues. You need 2 or 3, and every one of the top central banks has some very good people that may be there for different reasons, but they're great to talk to, and they generate lots of ideas. So I'm a big fan. A lot of my students end up going there and enjoying it.
Okay, very good. Let me switch gears back again. Do you have any comment on the various proposals to deal with dollar funding crunch across the globe, such as expansion of CD swap lines or SDR insurance? Anil, you want to go first on this one?
The Fed has been using these dollar swap lines in ways I don't fully understand as to which central banks get them and which don't, but it seems like it's very, very important. And, you know, I understand it's somewhat political, but for the good of the world, if the dollar is the reserve currency, you don't want people strangled by not being able to get dollars. So I think that's the simplest way to do it. I don't think an SDR type solution is very realistic. It's not going to be backed. I don't see that happening. So I think the dollar would have to decline quite a bit before it loses its prestige, and until the fiscal integration is fully done in Europe, the euro is not going to be ready. Nobody's going to want the yen, given the debt levels there and the shrinking population and everything else. China's not convertible enough. So I usually describe the dollar as the cleanest dirty shirt, and it's been that way for a while, and I think it's going to stay that way.
Hyun?
I thought when Shin gave a very good presentation yesterday. I thought her lecture was, really very good. Her opening slide, I think, really captured it, where she showed that the dollar is more than just the United States, in the sense that, yes, the dollar is the currency of the US, but it's also a global currency, in that if you look at what's happening, who uses the dollar and how much it's used, it has a very large presence in the financial system. And I think it's there's an element of a collective action problem, in that even for the invoicing of trade, Gita Gopinath and her colleagues have shown that dollar invoicing is very prevalent. And if you're part of a supply chain, if everyone else invoices in dollars, then you're best off doing the same. But everything sort of cascades from that, in the sense that if the invoicing is in dollars, then you want the working capital to be in dollars as well. And if the product that you're producing is also invoiced in dollars, like if you're an oil producer and oil is denominated in dollars, then for investment you would want to borrow in dollars just to mitigate that risk. That means that there's a lot of debt going around in dollars, issued by people who are not necessarily resident in the US. And if that's the case, then a typical global portfolio, fixed income portfolio, is going to have a lot of dollars represented there. So I think this is one of the reasons why, as when Shin showed yesterday in her presentation, there's a lot of hedging demand to hedge, back to your home currency. So if you're a fixed income investor in a rich country, you have obligations to your policyholders or your beneficiaries in your home currency, but a typical global portfolio will have a lot of dollar assets there. So you need to hedge that back to your home currency, and then you need global banks to take the other side. And so there's a lot of dollar intermediation going through the banking sector. So in that respect, it's something which is present at all levels of both the financial system and the real economy. And perhaps because of this, what we find empirically is that the dollar exchange rate has this property of being a risk indicator, or an indicator of risk capacity, where when the dollar strengthens, this is when risk-taking activity seems to fall, and vice versa. So when the dollar weakens, you have risk-taking going up. And I suppose because of this feature, there is this global dimension, and to the extent that the dollar is such a pivotal presence in the global economy, there is a public good aspect which comes from easing dollar strains there as well. And I think this is the way that I would view the swap lines and the actions of the Fed. I think it's as we remarked at the very beginning, I think one thing which is really remarkable this time around is how quickly the authorities acted, and not only the central banks, but also the fiscal authorities. And so while the stress in March was very sharp, it ended up being pretty short-lived. So I think that's the kind of the big picture that I would bring to this question.
Thank you, Luke.
Yeah, I have not so much to add to this, just maybe a bit of a euro perspective, because of course the dollar dominates. It's about 60% of all money flowing around is dollars, and the euro is only 20%, even though these two economic entities are, economic areas are broadly similar in terms of GDP and population. So the dollar is 3 times as big. But it doesn't mean the euro is tiny either. And it's also a bit of a political choice there as to how big you want to be. I don't think they have done themselves a great service in becoming bigger. I mean, you need to have very deep financial markets. As Hyun was also saying, a lot of these transactions are in dollars, but largely because a lot of these markets are based in the US. And internationally, and Europe is still a very bank-dominated system, and so most of these trades then take place offshore in dollars. Now, the solution doesn't matter whether it's euro or dollar. Indeed, if there is a shortage of liquidity, I'm with Anil, and the easiest course of action, and it's also what we saw again this year, is for central banks to have these swap lines. And at the ECB, we had a record demand for these swap lines. We have put in place numerous new swap lines, and not just for European countries that don't issue the euro, of all sorts of places around the world. So it's just to say that there is also demand for euros out there outside of Europe. Actually, interestingly, last year there was some dip in this demand coming from the fact that we did away with the largest denomination. So we have, just like in the US, different size bills, and we did away with the 500 euro bill because we wanted to fight anti-money laundering. And there are a couple of countries that were heavily using these large bills to flow money around. And so we've done away with that. But indeed, what is a bit worrisome, as Anil was saying, is that the choice by central banks to extend these swap lines seems to be too much a political choice. And I think that should not be the case. And if it is the case, it should not be done by central banks only. Then there has to be a bit of a clearer framework in place there, where either governments are involved or some international body. So I think there's room for improvement.
Very good. Let me turn to another question that was submitted then. Some central banks are reluctant to go into a negative interest rate territory. Is quantitative easing a better policy than negative interest rates in terms of boosting lending and investing in the real economy? So why don't we now start off with, let's see, who should I start off with? Luke, do you want to go first on this one?
I think it makes sense, since we were the first major central bank to go negative. So, that was one of the examples I would have of how research really influenced the debate, where basically the research at the time was very limited, but there were reasons to believe that while negative rates would stimulate the economy, there could be financial stability risk down the road. Hyun and colleagues had worked on that, but also in academia there were a few papers on that. But unfortunately, it's also one of these examples where research was lagging reality, and we had to take a decision, go negative or not, without actually a lot of fundamental research on that. And indeed, this trade-off was displayed then as we gave all the different arguments by the voting of the governors, some voting in favor and some not. In the end, of course, you know that the ECB went negative, so the majority thought it was a good thing for the macroeconomy. And again, our main objective is is an inflation one, and inflation was falling short. So I think for me, the difference between the two policies, negative rates and quantitative easing, is simply that quantitative easing, in my mind, works most effective when there's financial impairment in the system. It works through rebalancing of balance sheet, and so it's for that reason also that I believe that the first QE package of the Fed was the most powerful one. And it's for that reason that when the ECB launched its QE equivalent program, asset purchase program, several years later, it was less effective in some ways because financial impairment was not as severe anymore. What I mean by financial impairment is if, let's say, financial market spreads are very large, financial constraints are very much binding, it's at those moments that quantitative easing is most effective. So by the time that we had put quantitative easing in place and it had done its job and interest rates were already at zero, we had to stimulate further to get closer to our inflation target. And at that point in time, we viewed that QE was no longer a very effective tool, and negative rates would be much more powerful. And you know, with the risk of oversimplifying, I do think that there are negative consequences of prolonged negative rates because they can build up some financial stability risks down the road. But again, then there are other tools you can use to deal with that. But if in the short run you have to boost inflation, in the first order approximation, I think whether you decrease interest rates from positive territory or from negative territory is not such a big difference. And we have indeed seen in terms of our the effects that we have had, that we have estimated, they have been broadly in line with. So there's not really a distinction between moving interest rates in positive or in negative territory.
I think this goes back to what I was saying before, which is which other interest rates are in your model. So in lots of models, as a caricature, you could say the 10-year rate is a sufficient statistic for the amount of financial easing you can do. And whether or not you put the short rate to negative or you do QE, you've got, let's say now, the 10-year rate in the United States is 60 basis points or whatever it is. You've got 60 basis points of room, and whichever one you pick, you're going to get 60 basis of stimulus if you're willing to push hard enough. But once you go to a more nuanced view, you might think, well, it's actually the spread between bank rates and the safe rate that matters, or maybe it's corporate rates or whatever. So I think it's closely bundled up with what you think the other interest rates are for transmission that you need to account for to get at your, overall financial conditions index. And I don't think we've got great evidence on this. We don't have a lot of time series. We don't even have a lot of cross-sectional evidence. So I'm not sure we know very much. But I think right now monetary conditions are so loose, whichever way you read it, I'm not sure that the incremental effects of going negative are that big.
Hyun?
So Lars, I think this is an example of a question that really bears out some of the things we were saying earlier about the importance of knowing the plumbing and the financial structure. Because if we just simply write down a standard macro model and have intertemporal substitution, zero doesn't have a particular meaning. But if you have a bank-based system, then certainly it will have a bearing. The negative rates, will have a bearing on your interest margin, and at least in a partial equilibrium setting, you will have a lower net interest margin. that may bear on your intermediation activity. So this goes to Marcus Brunemeyer's notion of the reversal rate and whether that actually kicks in. The interesting thing, though, has been that if you look at some of the empirical evidence, if you look at some of the general equilibrium effects, there may be effects that go through not just the net interest margin, but also through to the demand for credit and just intermediation activity that is boosted through a stronger economy. So that's been an interesting debate. I think there is still an issue of whether many of those gains are one-off gains, and you will still have an issue if the negative rates tend to be protracted. So I think that's still to be seen. But I think it's, I think this is one of the questions where knowing something and bringing in features of the financial system will be really important when you try and look at. And the same goes for QE as well. I think we have to sort of track what the mechanisms are. I think there are at least 3 mechanisms, or maybe more, but there are at least 3 that I'm aware of, and I think we need to sift through those.
Okay, very good. I think we have time for one last question. I'm going to do my best to translate this. So I think this bears a little bit on some of the discussion, the political challenges that Luke was talking about. Coming out of this pandemic, one could easily imagine policy calls for things like universal basic income. What do you see as this as a policy, and what do you see this as a policy challenges, in terms of financial and fiscal challenges that go along with it? So Hyun, would you like to go first?
Yeah, I think we should distinguish between the short-term crisis mitigation set of policies from the longer-term public finance question about how to structure the tax and benefit system. So I think certainly on the former, it's been very important that we had the fiscal intervention to just soften the downturn. And I think in the absence of that, I think the macro impact would have been that much larger. The concern would be that not having brought the pandemic under control, the pandemic will be going somewhere in the world, and as long as that's happening, that we may need to dip further into the fiscal toolkit. And I think that's where all the issues to do with debt and fiscal space will come back.
Luke?
Yeah, I agree with what Hyun just said, that one has to distinguish the short-term and the long-term interventions. So I don't think because of this crisis, the crisis in and of itself doesn't call for universal basic income, but it does, of course, call for discussion around that. I think for me, the area where there has to be a big political discussion in terms of the tax and benefit system is it's clear that some industries will just disappear, will not come back. It's not just a matter of a lockdown. There's going to be a change, a likely big change to the industrial structure. So whatever system we're going to put in place, I think has to help people to be able to reallocate, whether this is through training, finding new jobs, being able to move in terms of housing and all that. And again, I believe in some sort of mix always between tax incentives and benefits, but also just economic incentives. It should not all be based on benefits, etc. And then the other thing, but that is more of a personal spiel, which is that I also worry that some countries will not embrace this as an opportunity to continue on a path that is positive in terms of climate change. I think that the excuses, of course, there is already costly enough to deal with just the immediate consequences of this crisis, and this may then be a short-term gain to save in that area. But I think that as humans, I believe we're smart enough to crack these 2 problems in one go, to basically reallocate resources to a more productive economy and not leave people behind, but also do this in a reasonably green way.
Thank you. Anil?
I think they've said most of what I was going to say, but I mean, we were already talking about central banks getting dragged into things for which they have, which they're poorly equipped. I don't know if Hyun and Luke saw that Joe Biden suggested that the racial gaps in employment, income, and wealth should be put into the Federal Reserve Act as an additional consideration. I mean, I'm pretty skeptical that the Fed can do very much about that. But, you know, when you've had central banks doing all these extraordinary, unprecedented things, people say, you know, why not one more? Let's, you know, why did these guys get helped and not those? So I worry about that as an issue, and it goes back to our debt discussion. But I think until we're past the pandemic, this stuff will go away. And I think Luke is right to worry that the younger generation cares a lot about climate, and there's going to be people that are going to come along and say, well, we spent your money and it went to the pandemic, so sorry, no more green this or that. I think that's a risk that could, you know, fissure society, because the divide between the young and the old in terms of climate change is pretty extreme. And the young are already bearing a lot of the costs of this pandemic, and the old are bearing a lot of the benefits. They're the ones that aren't going to die if we lock down. So if you say that climate went down the drain along with the pandemic, that's not going to sit well in the medium term.
Okay, thank you. I think our time here is about up. I would like to end by thanking all three panelists. I think for their superb and insightful comments, discussions. I think there's a lot to be gained. Lots of food for thought here, and lots of potentially good career advice from all three. So thanks to you, Hyun, thanks to you, Luke, and thanks to you, Anil, for your very insightful discussions and comments.